Welcome to another episode of Mayhem in the Markets, coming to you Monday, August 28th, and brought to you by MacroVisor, where we make macro actionable, and TraderAid, where we help you find your trading edge. On screen, we've got retail theft has more than doubled since 2015. This is concerning investors more and more. We can see in some of the retail earnings reactions where what is called shrinkage, but is theft, has caused some of these companies to lose a lot of money, a lot of inventory, and therefore investors flee the stock. It is something that we need to pay attention to because in some regions, in some localities, there's also much lower enforcement of any kind of theft, which puts stores in a disadvantageous position such that many are even closing their stores in such places. Next, we have quick serve sales. Check out Chick-fil-A. Is that not incredible? Each store makes almost $7 million per year. That's a pretty impressive haul. McDonald's, though, stands out on the chart in the number of stores and the sales per store. It really is a very resilient quick serve restaurant. And finding stocks like McDonald's, these are pretty defensive plays because they're cheap. And people go to them when they're struggling, and they go to them when times are good, so they tend to be more defensive. Global money supply is on the rise. It is led so far by Europe and China, with really China helping to drive a lot of that growth this year. And this is something that I think is worth watching. I don't believe it means that any sort of forward risk for the global economy is behind us because money supply is growing, but I do believe it means that we've had a bit of a cushion for some of the impacts we may have otherwise seen during such an otherwise aggressive tightening cycle. And when we take global money supply and we compare it against the performance of U.S. stocks, one thing is clear, that U.S. stocks are outperforming significantly versus global money supply. Now, this is a pretty strong correlation between the two. I would say it matters. I think it matters because we see these other divides and divergences, one more of which we'll talk about later in the slides, but it's something to keep in the back of our minds as we travel throughout 2023. Morgan Stanley's earnings estimates for the S&P 500 are flat 0% year over year, with information technology up just 1%, although you wouldn't know it with how these stocks have been performing. Now, I know we've divided tech into other sectors like communications and consumer discretionary to some degree with Amazon and Tesla, but infotech should be a pretty clean indicator for earnings growth in technology, and there's really not much to be seen. Why does that matter? Because these stocks are the leadership. They're not growing. Multiple expansion is not something that's a durable driver of gains. And the top 5 contributors in the NASDAQ account for 2/3 of all the gains year to date, with NVIDIA alone accounting for 6.7% of the 36.3% gains. It's pretty incredible to consider just how narrow this rally has been. And mega cap exposure, these same stocks are favorites among hedge funds. They have the highest amount of exposure that they ever have. And that's pretty important in terms of managing concentration risk. This is an area with extreme concentration risk. And on the other side of the book, these hedge funds are very short some pretty crowded stocks. The Goldman Sachs most shorted index is up 22% in August as they covered that side of the book as this side of the book was going against them. Central bank liquidity is highly correlated with tech stocks. We can see that that's not so much true anymore, despite the chart's title, with central bank balance sheets of the G3 falling while the NASDAQ continues to surge higher, only recently correcting a bit lower. I do believe this divergence is one that suggests stocks will catch down eventually. I'm not sure exactly when that happens, but I do think it's a growing risk because there's so many different divides and divergences that we are seeing here. And real assets, maybe it's time to look at things like commodities over the very long term. I don't know that we're out of the woods yet in terms of lower prices, but I think over the next 5 or 10 years, we could have some room for these to move meaningfully higher. I'm not so attracted to real estate here. I know that's a real asset, but I do think in commodities there will be opportunities versus financial assets, which could mean financial assets also move down in relation to commodities. But I think there'll be a bid in some of these things as there's structural inelasticity, a theme that we're talking about at Macrovisor in our abundance to scarcity discussion, research that I'm going to share the next chapter of this week. If you'd like to check out Macrovisor, you can actually get a 30% discount off your first year if you sign up in the next week. The average mortgage rate reached 6.54%, matching the 2002 average rate. This is incredibly high. We have mortgage applications that are at lows not seen since 1995. Home affordability in the U.S. for home buyers is at the lowest levels on record by many measures. So this is a pretty bad situation. And we do see home sales coming down. We do see home prices beginning to come down in some places. But I think the bigger risk here is just that the mortgage origination component of this market is being gutted. These are lows that we have not seen in a very, very long time. I think it suggests that there is going to be some weakness that will translate to the housing market as well, particularly because prices are so high, rates are unforgivably high. A lot of people are just not able to afford that first home. And if they have an existing home, they want to keep that mortgage they locked in at about 50% lower or more in their rate. They may be at a 3 or 3.5% rate. And finally, last slide here is China construction starts are at their lowest level since 2010. This is a country where the reopening is just not really manifested. It's not been anything of any real discernible economic acceleration. I think it's very concerning that the second largest economy in the world can't get off the ground. Their consumers aren't participating. Real estate developers and construction companies are languishing. There's a lot of defaults in those real estate developers. And then you also have export demand very low because most of the global economy is slowing. So I want to thank everyone for tuning in. Really appreciate all of your support. If you'd like to check out my work, check out macrovisor.com and traderaid.com. Really doing some awesome stuff over at both of these startups that I've been working on. At Macrovisor, we're talking about the big picture. At TraderAid, we're talking about shorter time frames. But if you're interested in either one of those areas, we've got some great promotions going on right now. So check it out.